Petroleum, Timi Presiavia, said that the contract awarded to an Italian company will be carried out in 3 phases. According to him, the funding already in place is drawn from 3 components: the NNPC internally generated revenue, budgetary allocation provisions, as well as Afrexim Bank. Well, Mustafa Wahab, oil and gas analyst at Chapel Hill, Durham, joins us now. Good morning, Mustafa. Thank you very much for joining us.
Thank you for having me. I'm happy to be with you this morning.
You're welcome. So what are the major takeaways for you from the new FG's approval of $1.5 billion for Port Harcourt Refinery rehabilitation? Should we be excited about this?
Thank you so much for the question. There's a lot to unpack from this, actually. So number one is that what is becoming, a general knowledge is that Nigeria's government now sort of appear to be addicted to importation of PMS products, and I do not think that this sort of addiction can be beaten, right? So we have a combined refinery capacity of over 445,000 barrels a day. And yet, in the last 10 years, what we've seen is that, those combined capacity has barely reached, 15% utilization rate. In fact, in January last year, these refineries have been moribund, despite this massive amount of dollars that they've spent, on their turnaround maintenance. So personally, I think, I see these refineries as another white elephant project in Nigeria. That may never, come back to life. Just so I put it in a better perspective, Port Harcourt Refinery alone, is around 125,000 barrels a day plant capacity, and was shut down last year, January, just basically to, complete appraisal of the refinery for, total revamp, right? What we saw was that, FGN basically set a target of around 2023 to bring it back to life, to run at around 90% capacity utilization rate, which is more or less a pipe dream as far as we are concerned. Just so I backpedal a little bit, it's not necessarily a pipe dream really to revamp the facilities, since the plant is only 40 years old, right? And we've seen older plants globally that are actually running quite strongly today. But I think the real problem is that, from our estimate in-house in Chapel Hill, we think that restructuring Port Harcourt Refinery alone, to a cleaner fuel levels as that of Dangote Refinery would cost nothing less than $1.7 billion. That's even aside, any additional costs, for repair. Now, in the grand scheme of things, the 1.5 billion approved by the FGN isn't really too far from our estimate. But the key question is, who is going to finance this sort of investment? And obviously, what's going to be the investment case, especially with the potential competition from Dangote coming, in 2023. What we know right now is that, FGN has actually laid out, 4 key funding sources. They stated that NNPC, IGR, budget allocation, as well as, a partnership from Afrexim Bank to basically fund this sort of project. But, the structure is yet to be disclosed. And secondly, the key problem we have in-house is that, why are we still talking about, revamping refinery when, the globe is already shifting to greener and cleaner, energy, right? You go to Norway, for instance, which is a country that basically relies on oil and gas revenue, as with Nigeria. They basically stated that by 2025, they want to, end the sale of, fossil fuel-powered cars in the country. Beyond Norway, 9 other countries have also, potentially stated that they would ban any internal combustion, engine between now and the next, 10 years. So even if we play, a devil's advocate and assume that the refinery comes back to life, the question becomes, for how long, and will it be, relevant in the grand scheme of things? I think that FGN would have to, reprioritize or re-strategize to basically focus on more, projects that have, stronger investment case.
$25 billion has been spent on turnaround maintenance of refineries in the past 25 years. So would you advocate for rehabilitation or build a new one?
Thank you so much. Really, this sad story about refinery in Nigeria is the fact that just 3 years ago, we saw the Nigerian government basically sorting, external financing, to revamp the domestic refinery. And that's basically due to collapse in oil prices and obviously, shortage in availability of FX, for PMS importation. What we saw was that sort of effort eventually hit, a dead end since, the government was not able to convince any reasonable investor of the viability of that sort of venture, right? I suspect that's the reason why a Dangote, for instance, would rather, invest in greenfield project rather than acquiring, a new one. I mean, the truth is that nobody really knows, how bad things are in those plants. They are probably already corroding, which makes, any attempt to revamp those refinery a very difficult task. So I think that it would be a lot more sane for the government to argue, or convince investors, to invest in a newer refinery than revamping, the old one. So in-house, we think that, it will be a lot more sensible for them to, start to talk about raising funds, to build a new refinery rather than, wasting this lump sum of $1.5 billion dollars into revamping the old refineries.
Now, as an alternative, the government has been talking about modular refineries. What happens to those ones? Should that be really an alternative?
Yeah, I mean, it should be an alternative, but the key problem with modular is that, I mean, in Nigeria alone today, we consume up to 17 billion liters of PMS products, in a year, right? So the key question is, could modular refinery alone supply this sort of massive amount of demand? The question is probably no. So I think what FGN is trying to do is that, to substitute for this massive amount of effect that we push towards importation of PMS products, just basically makes sense, to refine those products in-house in the country. But the problem with modular refineries is that they don't have enough capacity to supply, domestic demand. That's why, you need an alternative source.
All right, $1.5 million is $1 billion, is a big number. What impact do you think this will have on Nigeria's revenue and debt servicing at this moment?
So, I mean, for revenues, for debt service, really, the last time we checked, debt service, revenue is now, hitting the ceilings of, 70 to 75%. What that then means is that for every $1 Nigerian government earns in terms of FX earnings, 75 cents basically goes to debt servicing. So that basically means that, the country is already broke, right? So if you want to, invest in this sort of venture, it then means that you would have to, start to rack up more debt or more borrowing. So the key question is that, do we have enough room to continue to rack up more borrowing? I think the answer is not, right? So on revenues, things are already tight. The good thing is that we've starting to see, oil price now flexing with the $70 per barrel levels, which basically makes a lot of sense, for oil revenues. But on the other leg, Nigeria's budget deficit still top, the 5.5 to 6 trillion, levels, right? So it just basically means that, to at least see any reasonable budget implementation this year, we would have to, borrow more. And I don't think personally that we have enough room or enough appetite to continue to rack up, borrowings in the country.
Now, as an analyst in the oil and gas sector, how committed do you think Nigeria's government is in the process of deregulating the downstream sector?
So fantastic. I already mentioned it earlier that debt service to revenue ratio is close to 70% for Nigeria today. It just means that, we should not even be talking about the question of subsidizing, PMS right now because, there's no funding, to meet those sort of venture, right? So the key question becomes, does the government have, the appetite, the room to eventually liberalize the downstream sector in the country? The answer is probably not, right? The stories, you've seen the numbers. Inflation, for instance, is at 17% levels. Unemployment rate is more than 33%, right? But beyond that, we've also seen GDP for full year 2021 being negative. It just means that there's a lot of structural problems in the country that would ensure that the government will sort of remain apprehensive towards leaving the downstream sector to market forces to determine, right? So what we think is that is most likely for us to continue to see, subsidy payments in the country between now and the nearest future. So what we did in-house in Chapel is that we estimated that the government could potentially spend at least, more than ₦1 trillion in subsidy payment between now and the end of 2021 should oil price remain at $60 per barrel levels and exchange rate of around 401 naira to a dollar. So the question is, where is this money going to be coming from? Because as of the budget for 2021 budget, we don't think that, we've not seen any under recovery or any subsidy that is being budgeted for. So what that then means is that we'll probably start to see FGN funding that sort of subsidy from any surpluses that is coming from NNPC operation for full year 2021.
Okay, so what's your outlook for global oil prices and what does it mean for PMS price in Nigeria?
In terms of oil price for us in-house in Chapel Hill, what we think is that global oil demand this year is going to struggle, to meet the 2019 levels. And that's basically because of the fact that vaccination campaign is still moving at a slow pace globally. It then means that, government generally would continue to restrict, movement and any economic activity, which just basically means that, demand for petroleum products would remain largely muted. But for us is that we think the extent of supply cuts by OPEC and its allies would basically determine, the direction of crude oil prices this year. And so if OPEC and its ally, maintain, current production cuts, we think that it is possible for, supply, to basically run, below demand. What that means is that, the impact of that will basically, put some sort of a floor on oil prices going forward. In Chapel Hill, we're expecting oil price to average between $60 to $65 per barrel. If you take that into pricing template for the PPPRA, what you see is that at $65 per barrel level and 401 exchange rate for exchange rate, what we think is that pump price should trade nothing less than 222 naira versus current selling price of 168 naira per liter. What that then means is that we will start to see FGM basically subsidizing close to 55 naira per liter for the Nigerian citizen going forward if they decide to leave price at current level.
All right, Mr. Wahab, before we let you go, what impact do you see oil prices will have on earnings of upstream and downstream listed?
Thank you very much. For upstream players, the only listed exposure that we have is currently Seplat. And as at full year 2020, we've seen Seplat reporting around $85 million in loss. And that's basically due to the collapse in oil price that affected revenues. But beyond that, because of the material decline in oil price, we also saw Seplat reporting close to $164 million in impairment charges. For us in 2021, oil price already flirting with $65 to $70 per barrel level. What we think is that two key things would drive Seplat to profitability this year. Number one is, significant, the recovery in oil price that we've seen. We think that would have, significant positive impact on, revenues for the company and also on cash flow generation. But beyond that, we also think that there is strong likelihood that those massive impairment charges that Seplat reported last year will probably be reversed this year. And the impact of that would obviously support, bottom line. For downstream players, the narrative is still going to be the same. Right now, margin is significantly squeezed, and that's basically because of the fact that NNPC remains, the major importer of PMS products in the country. We checked, we attended Aridova's, conference call recently, and what we saw was that, margin is still quite tight and squeezed. So what we saw was that the company is basically, trying to, protect margin by, pushing a lot of, loops products where, margin is at the highest, right? So what we think would be the key game changer for downstream player is probably the passage of the PIB, which will basically allow, producers or oil marketers to basically, import their own products, source their own FS and obviously charge, any prices that they feel comfortable with. That's
All
basically
right.
what we think will happen for the downstream players.
All right, thank you very much, Mustafa Wahab, oil and gas analyst with Chapel Hill, Dunham. We appreciate your time.